Hi, I'm Cleon from ClearTax. In this video, I will tell you how to build a tax-free corpus for retirement. You can build a tax-free corpus for retirement while you're earning. You may choose the investments that can be useful in building a tax-free corpus for meeting long-term financial goals in a range of 10 to 15 years. You can use the corpus funds for any financial emergency, for buying any assets, such as an immovable property. Let us understand some investments which can help you in building tax-free corpus. PPF or the Public Provident Fund. PPF or Public Provident Fund is a government savings scheme. Any individual can invest in the scheme. PPF is a lock-in period of 15 years. PPF is eligible for a tax deduction up to a maximum of Rs 1.5 lakh per year under Section 80C, the Income Tax Act 1961. The interest credited to your bank account and the proceeds at maturity are tax-free. PPF currently offers an interest rate of 7.1%. The changes in rates are notified by the government from time to time. Equity-linked savings scheme or ELSS. The equity-linked savings scheme or ELSS is a tax-saving mutual fund. ELSS invests most of the corpus in stocks and is subject to a volatility in the stock markets. ELSS may offer inflation-beating return in the long run. ELSS is eligible for a tax deduction to a maximum of Rs 1.5 lakh per year under Section 80C of the Income Tax Act 1961. ELSS also has a 3-year lock-in period. The investment in the growth plan of the ELSS is to build wealth in the long term. The redemption proceeds are liable for a capital gains tax. However, you can enjoy a tax exemption up to Rs 1 lakh per financial year on the long-term capital gains earned. EPF or the Employee Provident Fund. The EPF contribution made as a salaried employee helps build a retirement corpus. You make EPF contributions from your salary, and your employer also makes a matching contribution. While changing the job, make sure you transfer your EPF account to the next employer to reap the benefits from the EPF account. From a tax perspective, an employee who stays continuously in employment for more than 5 years can claim a complete tax exemption, time of withdrawal, the EPF balance. Continuous employment also includes transfer from one employer to another. NPS or the National Pension System. NPS or National Pension System is regulated by PFRDA, the Pension Fund Regulatory Authority in India. Individuals in the age bracket of 18 to 60 years can contribute to the NPS. From a tax perspective, contributions to NPS are eligible for tax deduction to Rs 2 lakh per year under Section 80C and Section 80C CD1B. Upon maturity at the time of retirement, you can claim 60% of the proceeds in a tax-exempt manner. The balance 40% must be compulsorily invested into an annuity plan to receive regular pension benefits. The pension amount from the annuity plan would be taxable. Life insurance plan. You can avail a life insurance policy from any insurer or LIC of India. You can choose the type of policy and the term of the policy. The premium payments are fixed accordingly. You receive your maturity proceeds at the end of the term of the policy. From a tax perspective, the premiums paid are eligible for tax deduction to Rs 1.5 lakh per year under Section 80C. The deduction is subject to the condition that the premium paid should not exceed 10% of the sum assured under the policy. In case the premium payment exceeds 10% of the sum assured, the deduction is available for 10% of the sum assured. Upon maturity, the proceeds are completely tax exempt if the premium paid does not exceed 10% of the sum assured. In case the premium exceeds 10% of the sum assured, the difference between the maturity amount and the total premium payments gets taxed as income. Thanks for watching.